Welcome to this explainer. Let's just jump right into it. The US government recently offered to buy 90% of a major airline. Now, if you're an average retail investor, that probably sounded like a massive rescue operation. But if you're paying attention to the math, that's not a bailout at all. It is a blaring, flashing warning sign that your supposedly safe dividends might actually be sitting on a liquidity landmine. Today, we're diving deep into how the brutal 2026 macroeconomic environment, combined with a brand new era of state-sponsored capitalism, has completely permanently altered what it means to hold a reliable asset. The old playbook of just buying the dip on legacy blue-chip brands, it's actively breaking down. So we are going to map out exactly how to protect your capital from getting completely wiped out in this new reality.
So let's unpack that brutal truth right off the bat. When the news broke that the US government was stepping in to quote-unquote rescue a major national carrier, everyday investors legitimately cheered. They thought the cavalry had arrived. We've all been taught for decades that critical national infrastructure is simply too big to fail. But here's the reality check. State-sponsored capitalism has fundamentally shifted the very definition of failure. Today, it's no longer the physical company or the utility that fails. It's the shareholder. The government steps in to save the planes, they save the routes, and they save the jobs, sure. But they do it at the absolute expense of the existing equity. So if you're holding common stock, a modern bailout means you are being liquidated. Period.
Here's our roadmap for today's explainer. First, the liquidity landmine warning. Second, the Spirit Airlines autopsy. Third, the common equity wipeout. Fourth, defining the bailout zone. Fifth, government-anchored equities. And finally, the Fortress Dividend strategy.
Section 1. The liquidity landmine warning and the 2026 macro energy shock. Okay. We have to start with the geopolitical catalysts that actually triggered this massive financial restructuring. I'm talking about the severe 2026 Iran war energy shock and the subsequent closure of the Strait of Hormuz. That event completely severed the main artery for 20% of the entire global oil supply. Almost overnight, U.S. jet fuel prices absolutely skyrocketed from $2.50 to $4.88 a gallon in just 6 weeks. That is a 95% jump. And it triggered catastrophic EBITDA destruction. Now, in plain English, your EBITDA is basically your core operational profitability before all the tricky accounting kicks in. For ultra-low-cost carriers who already operate on incredibly razor-thin margins, having fuel jump from a quarter to nearly half of their total operating expenses wasn't just a bad quarter, it was a fatal liquidity trap. It literally got to the point where simply flying a plane cost substantially more than just leaving it grounded on the tarmac.
Section 2. The Spirit Airlines autopsy. A major warning for common equity. Let's look at how this played out in the real world with Spirit Airlines. Spirit had actually just emerged from what looked like a hopeful restructuring called Project SOAR in early 2025. But because of insurmountable reorganization expenses and some incredibly overly optimistic fuel projections, they were forced right back into what the financial industry calls a Chapter 22 bankruptcy. That's just a grim term for a company that refiles for Chapter 11 within mere months of their first exit. By the time that massive February 2026 energy shock hit, the math for their survival was physically impossible. The revenue they generated per passenger couldn't even cover the sheer cost of the fuel required to lift them into the sky. They were aggressively incinerating cash every single minute they kept the lights on. Which brings us to April 2026. The administration proposed a $500 million rescue package to preserve up to 17,000 jobs. Sounds great, right? But the brutal truth was hidden in the mechanics of the deal. This financing was secured by warrants. If you're not familiar, a warrant is essentially a financial instrument that gives the holder, in this case the U.S. Treasury, the right to claim an ownership stake at a predetermined price. The specific terms of this deal gave the government a massive 90% ownership stake in the reorganized company. The administration swoops in, they get to save the critical national infrastructure, but they absolutely devour almost all of the equity to do it. Section 3. The common equity wipeout and the absolute priority rule.
You see, bankruptcy law doesn't care about retail sentiment. It runs on the absolute priority rule, which dictates a very strict waterfall of recovery. First in line, the new debtor in possession, or DIP lenders. These are the highly aggressive financial entities providing the emergency cash just to keep the business operating during the bankruptcy process, and they demand super priority status. Next up are the secured note holders, the guys who actually have legal claims to physical assets like the planes themselves, then unsecured creditors. And way down at the absolute bottom of this waterfall, at step 4, sits the common shareholder. When the government steps in with that 90% stake, they enter as a senior preferred holder. The utility functions of the airline continue, sure, but mathematically, the value of the common equity drops to a hard, unforgiving zero.
Now, everyday retail investors saw those initial bailout headlines, thought it meant safety, and blindly bought the stock. This triggered a massive 122% dead cat bounce, which is a temporary, completely false illusion of recovery. Guys, it was literally the financial equivalent of fighting over a deck chair on a sinking ship. They fundamentally confused the survival of the national infrastructure with the survival of their personal stock portfolio. They entirely ignored the fact that their so-called once-in-a-lifetime buying opportunity was actually a liquidity landmine waiting to explode right in their faces.
Section 4, Defining the Bailout Zone using our quantitative models for 2026.
To protect ourselves, we have to clearly identify what I call the bailout zone. If a company is operating here, specifically with a debt-to-EBITDA ratio above 6.0x, their enterprise value is essentially a mirage. To put that 6.0x in perspective, it means it would take 6 entire years of their core operational earnings just to zero out their current debt pile. On top of that, if they carry an interest coverage ratio below 1.5x, they are barely generating enough cash to pay the interest on their loans, let alone actually touching the principal. In this zone, a company's survival relies entirely on political intervention, not market forces. And as we've seen, government stabilization here turns the physical assets into a fortress, but it turns the shareholder equity into a mass grave.
Let's contrast Spirit's terminal collapse against a giant like Boeing. Yes, Boeing carries over $54 billion in total debt, which sounds terrifying, but their debt-to-EBITDA ratio remains safely in what we call the buffer zone, well under 3.5x. Because of this structural balance sheet fortitude, combined with a truly massive multi-year order backlog, Boeing was successfully able to raise $24.3 billion in private equity. They act as a stabilizing proxy for the entire aerospace sector. They are fundamentally intact enough to raise private capital on the open, free market. That means they completely avoid the government's 90% equity trap because they are simply too large and, critically, too financially viable for the state to swallow whole.
Section 5, Government-Anchored Equities and Finding the New Safe Yield. This is where we have to completely pivot our perspective. In an era of sudden, violent macro shocks, true safety means buying the companies the government absolutely must pay rather than the failing ones it must save. We are talking about government-anchored equities, defense primes, and critical infrastructure giants, whose revenues are deeply structurally tied to rigid federal budgets. Because their income is practically guaranteed by national security mandates, their dividends start to act as quasi-sovereign debt. Holding their stock pays a yield that is almost as functionally reliable as holding a U.S. Treasury bond. It deeply insulates you from everyday consumer panic.
Take a look at L3 Harris as the perfect example of this massive paradigm shift. They are backed by a staggering $36.3 billion Pentagon backlog. Now, a retail investor out there chasing high, risky yields might totally dismiss their seemingly low 1.11% dividend. But in this specific macro environment, that 1.11% is an unbreachable fortress. It is fully insulated from energy shocks. It's insulated from consumer discretionary pullbacks. Why? Because the capital funding that dividend is essentially guaranteed by the sovereign government's unyielding, non-negotiable need for advanced national security hardware.
Section 6, the Fortress Dividend Strategy and Screening for the Free Cash Flow Alpha.
To actually find the alpha here, we are screening specifically for a free cash flow yield above 8%. A high dividend yield alone is frequently a trap. You need to see the raw underlying cash generation flowing directly into the company's coffers to ensure that dividend isn't suddenly slashed the second a crisis hits. Companies like ON Semiconductor and Qualcomm might be broadly categorized as tech, but they actually hold massive critical infrastructure exposure. With their debt-to-EBITDA ratios sitting comfortably well under 2.0x, they are generating immense rivers of free cash. And that structural cash flow is the ultimate hedge against both severe energy shocks and sudden government dilution. Take a mental snapshot of this, because this right here is your definitive checklist for investing in state-led capitalism. You demand a debt-to-EBITDA ratio strictly under 3.0x. You demand free cash flow yields above 8%, running right alongside a solid positive net cash position. Remember, as we navigate 2026, severe market volatility isn't an anomaly anymore. It is simply the filter that separates the true financial fortresses from the corporate corpses. You protect your portfolio from the next crisis by explicitly buying what the government reliably buys, not what the government eventually bails out. As we wrap up this explainer, I want to leave you with a crucial challenge. Critically audit your own portfolio today. Honestly evaluate the balance sheets of your favorite historic dividend payers. Ask yourself, are you holding the new anchors of national resilience, armed with the undeniable free cash flow to survive a massive global shock?
Or are you just blindly buying the dip on the next corporate autopsy, waiting for a government rescue that will inevitably wipe your equity to absolute zero? The fundamental math is clear. The choice is yours. Thanks for joining me, and I'll see you next time.